right, guys. Well, there he is, my good friend, Serge Berger. Serge and I have known each other for many years, broken a lot of bread, even got the awesome chance to meet his children. And he had some elves come by and read them Red Llama, Red Llama. And that was like the highlight of my Christmas that year, watching those little girls watch those elves come in and read a Christmas story to them. So Serge, let's go back to him. The Steady Trader is the name of his company, and that's legit, right? So you think about a lot of traders that you meet that are in and out of the market very quickly. Maybe they're doing trades you can't really keep up with because it's too fast, or it's too much equity that you have to put on the line to be able to stay in those trades through drawdowns or whatever it is. I mean, y'all all know you've been there, right? You know that you've been in a situation where you found somebody that you wanted to work and trade with because you liked their personality, but you just couldn't make the trades and you didn't see the long game, right? Because with trading, I really want you guys to think about it like this. It's chess, not checkers, right? We're playing a game of chess here. We're not playing checkers. And that is what I think about when I think about my friend Serge Berger. And the name of his company couldn't be any smarter because he is the steady trader. He's been around the block and back again, traded millions of dollars and traded hundreds of thousands. He's got from a $5,000 account to, you know, massive hedge funds he's run. He's been all across the board, but he's always done the same thing, and that is be steady about his trading and investing. He and I are great friends and colleagues, and I'm thankful to have him in my TradeThirsty family. And today he's going to be talking about steady incomes and options. I know this presentation. I know the traders. I see the members. I see everything that he brings to the table, and he's the real deal, y'all. So Serge, it looks like he's trying to mic up. I see him hustling around over there. There he is. Hey, buddy.
Hey, I'm blushing. I'm blushing, Jeanette.
Hi, Serge.
Thanks for scaring the crap out of me with that lean back. I'm like, oh, here we go. Tech issue.
No.
What's
I was
he
just checking some positions over here. But did Raleigh tell you that he sent me an email and would he call me today?
No.
Stephanie.
Stephanie.
Just a typo. And he said whatever. He's a chameleon. He can be anything. As a matter of fact, I thought he was looking for his elf outfit there for a minute.
Well, look, Stephanie over there in their shop is a hottie toddy. She's a cute girl. So maybe that's what happened, right? Maybe he was just conjuring some Stephanie through you, Serge. I don't know.
I wish I could. It was that.
All right, Serge, you have until the top of the hour, and we appreciate you being here today. I want everybody to give it up for my good friend, Serge Berger. It's all yours, buddy.
All right, thank you. I'm going to turn the camera off because I don't want it to be distracting to the presentation. So let me just do that first and foremost. Stop video. I think that will do it. Hopefully, I just turn off the whole webinar. Anyway, guys, hope you all doing well. I'm going to quick get the thing up here so I can see the questions. Using a strategy that I've used now for the better part of the past 20 years, all the way from JP Morgan through family offices, and we're using our own investment management company as well, of course. And that has to do with really focusing on high probability trades. I think a lot of people, when they trade options, are not really aware of the risk that they're taking. Partially because it's some of the stuff that's being taught is very risky, and quite frankly, a lot of it has to do with just the fact that greed comes into play with a lot of.
Hey, Serge, excuse me just for a second. Are you sharing your screen at this point?
Oh, I should probably do that. That's a good point. 1 second. Sorry. All right. Here we go. How's that?
Okay, there you go. That's great.
Sorry, I was so focused with you guys not being able to see me, so I can stand up because I'm only wearing shorts. I'm just kidding. I'm wearing shorts.
And the other quick little thing on this from a technology standpoint, we're getting a lot of echo on your sound. Are you?
That's because my microphone is probably the wrong one. 1 second. So the microphone should be. 1 second. It's this one here.
How does this sound? This should be much better.
Oh, much better. There you go. There you go. You're ready to rock and roll. We see you.
Sorry, guys. It's been a busy trading day already, and with Raleigh calling me Stephanie, You're
all on Twitter.
Anyway, so that's what we're going to do. And I think what we're going to start off with is just a little bit of perspective on the markets. And then we'll go through, because I think what you'll find here in a minute is that the market environment that we're in, based on what I'm going to go through, is is actually a lot more volatile than you think. And so what I really believe in is that you need to adapt your strategy a little bit. I'm not saying you have to completely change everything, but there's a couple of minor tweaks that you have to do if you want to be much more steadily profitable. So first of all, let's go with a bit of a market overview so we can lead into the strategy. This is a chart I just came across today, and this just, I mean, it's just a staggering chart, to be honest with you. And to make it simple, just look at the blue line. The blue line basically shows you the amount of calls that are being bought minus the puts. So basically upside call buying. I know today we have a bit of a more volatile market and we're seeing a mean reversion about time. But the upside call buying is really just completely insane. Now, this does not mean the stock market has to fall apart, but in my personal opinion, we are in a stock market mania. Stock market mania does not mean the market has to fall apart. It just means that the market is in a mania, which means it can do crazy and wild things at a moment's notice. Today is just one little example of that. So despite the fact that the market's going up every day, except for today, finally, only about 30% of stocks in the S&P 500 are currently above their January, February highs. I just want you guys to think about that. Again, I'm not trying to tell you that the market's about to fall apart in a major way and we're going back to the March lows. It's possible. It's not my base case, but I want to give you guys some perspective. So we're at a very interesting period in terms of the year and also in terms of where we are in the US presidential cycle. And so this chart is very interesting. And by the way, if you guys want to take a picture of some of these charts on just by all means, feel free to snap away on your phone, or if you need a screenshot. These, I think, are really important charts everyone should be aware of as we head into the next couple of 3 months, really through the end of the year. And what you're looking at here is sort of the back-to-back months performance history of the S&P 500. And you can see that the August-September back-to-back month period has the lowest return of any other back-to-back month over time. This is a statistic that goes back to 1985. Now, given the fact that we had August with the S&P was up 7% or something like that, one would have to expect that if this statistic holds true, and we don't know if it holds true this year, one would have to expect us to have a pretty crappy September. The odds are there. It's certainly not my, saying it's not 100% guaranteed, but it's possible and potentially likely given the statistic. So here are the 4 pillars, the 4 things that we're really focusing on through the rest of the year. Number 1 is economic weakness. I think a lot of people are not really aware how weak parts of the economy really are. There's a lot of hardship out there, economic hardship on a personal level, and I do think ultimately that is unfortunately going to come home to roost. Second thing, we have obviously a U.S. election that's going to start heating up here probably after Labor Day. Thirdly, COVID-19, unfortunately, that needs no introduction. I think we need to get more news flow on that as well. And then fourth, which quite frankly is probably the most important thing of all, is this zero interest rate environment with gargantuan monetary and fiscal accommodation, which is really what's driving the markets in a very big way. Now, if you're asking about seasonality, here's an interesting chart I came across, I think last Thursday or something like that. This is data going back to 1928, and it takes the presidential cycle year 4. And so basically the type of year we have right now this year. And in that type of a year, you can see typically we have a summer rally, June, July, August, so we can check that off, we had that. But then we tend to have seasonal weakness in September and October. So we'll see if that happens. I tend to think it's likely. And then potentially we'll see a year-end rally in November, December, which is kind of usually happens anyway in any given year. If you want to talk about volatility, this is implied volatility, and we'll talk about what that is in a bit. You can see that volatility tends to kind of steadily rise, and it tends to rise in these election years. Again, this is going back to 1928. You see a steady rise in implied volatility, and in fact, it's actually already happening. So if you look at the VIX futures curve, if you don't know what that is, don't get scared. I'm just showing you a chart, and then you can forget about it again. But basically, what this is the VIX is the S&P 500 implied volatility, and you can already see that the forward prices or the future prices or the future contracts, if you will, are already much higher. So the VIX on the October expiration is already at like near 30. And I took this chart a few days ago, so it's probably a little bit outdated. The VIX is obviously much higher today. So, but this is interesting to know. So it's actually already being priced into the market. What we are starting to see, and we've seen this across, institutional sales desks, even some order flow happening on the institutional side, and some of the high net worth individuals have started to short some futures about a week and a half ago, probably the highest clip that we've seen since June, when we had a record amount of future shorts, which then got squeezed and the markets went higher. All of this to me just means we've entered a new era. If you look at the S&P 500 90-year return, 90, it has about a 10% annual return. So over the past 90 years, the S&P's returned about 9.8% per year on average. Obviously, this is the average number. Some years it's much higher, some years it's worse, but on average, 9.8%. The trouble is that over the past 10 years, the S&P's returned about 14%. That's, let's call it, 14%. So that's about 40% more than the average long-term return over the past 10 years. And history speaks that when you have a decade like the one we just exited that has such a above average long-term return, 10-year return, I should say, you tend to see the next decade be very, very different. So I think I would be surprised if the S&P 500 this decade we just entered this year has an average annual return of more than 3 to 5% for this decade, the whole decade here. And that is going to be a problem for a lot of people. Think about it. How a lot of people have basically started counting on a 10% return per year. And if they don't get that, they have a problem. So I'm going to show you guys how we can circumvent that problem, though. So a couple of other problems that are there is sort of the massive backbone of the rally for the past decade has been U.S. corporate buybacks. Companies buying back their own stock. A lot of companies have slashed or at least or completely eliminated their buyback programs due to COVID-19. The question is, who makes up the slack in that demand? I think that's going to be a problem once we maybe get past 2020 into 21, and that's probably going to come home to roost at some point then. I'm going to skip a couple of charts here. Want to go and just quickly look at the S&P 500. Everyone always wants to navel gaze at the S&P, so we'll do that here as well real quick. This is what it looks like right now. Of course, today we have a down day. So what you can see is we had an overshooting move in January, February on the long-term 10-year trend. Then we undershot in March. And now we're overshooting again. My base case is most likely we're going to mean revert back into this channel, or at least to the upper end of it. So short term, basically what I'm trying to tell you is I think we're ludicrously overbought, to put it very simple. This is just another way of looking at the chart I showed you before. Extreme levels of call buying, basically no put buying. You can see the put to call ratio. And again, obviously today this is switching a little bit, but it's still extreme bullishness, extreme complacency, I guess is the word I really should be using. Same thing over on the NASDAQ. No surprise there at all. Apple, in the meantime, is a 7% weight of the S&P 500. The last time we had a stock anywhere near this, making up this much of the S&P, was in early 1980s. IBM made up 6.4%. I was only, let's call it 7 years old at that point, so I wasn't trading yet. But some of you guys that might have been around, you may have known that IBM was a big deal back then. And of course, you can see that didn't last very long. So it's just important to kind of put things into perspective. This is not to say that Apple's a bad company, just kind of putting things into a little bit of perspective. At the end of the day, a lot of this is very bullish for things like gold. We think gold could actually go towards the high 2000s, maybe 3000 over the next 12 to 24 months. So a lot of this is really based on monetary debasing, call it money printing, if you will. And so the bond market telling us a very different story as well. Bond yields going lower, bond prices probably going to continue to go higher for the time being. Again, yours truly, I'm not going to introduce myself a whole lot more, but you saw me live sitting at the very same seat just a few minutes ago. I have been very fortunate to have worked on trading desks for a lot of my career, and also have been at various family offices and hedge funds and things like that. And I am the co-founder and chief investment strategist at TheSteadyTrader.com, and the CEO and co-founder and founding partner at Blue Marlin Advisors, which is an RIA registered investment advisory company. So let's talk about this a little bit. If you look at the S&P 500 over, let's say, any 12-month period, and I just picked like a 12-month period here on the right-hand side, you can see that the S&P 500 has a pretty random distribution. It has big up months, big down months, and anything in between. And for a lot of people, this is a problem. The reason why it's a problem is because a lot of strategies are being taught, and it almost doesn't matter what the strategy is on the retail side. It is fairly, if not very positively correlated to the S&P 500. So today, a lot of people might look at their portfolio. The S&P 500, as I'm speaking here right now, is down. I don't know, is down quite a bit here today right now. And probably if you look at your portfolio, it's probably down as well. That's a problem. Because it means it's going to be very difficult for you to have a steadier return. So I do have a quick question for you guys, and I promise this isn't going to be like one of those constant Q&As and every 5 minutes. But I do have a question. Type in yes if it is one of your goals to have some sort of a monthly positive return or an income or like a quarterly positive return from your portfolio in the stock market. Like the average millionaire in the United States has about 7 sources of income. Right? So type in a yes if it is one of your goals. And again, it doesn't have to be every single goal you have ever, but like, is it one of your goals to have some sort of a quarterly or again, maybe monthly positive return? And empirically speaking, I know a lot of people are going to type in yes. And by the way, I'm asking you this question, not because I'm taking notes, but because I want you to be aware of that is one of your goals. A lot of people are actually not even aware of that. What I'm here to tell you is that most strategies that are being taught out there are very ill fit for you to achieve that goals. In the past 22 years in this business, in the past 20 plus years of doing the strategy I'm about to show you, I can tell you I've seen anything and everything, and most things simply aren't going to give you that return because they're either way too risky or way too closely pegged to what the S&P 500 does, willing or not. The option strategy that we're about to show you, this is what it looks like from a sort of P&L curve. It's much, yes, you can make a lot of money, and that's nice, but it's much steadier in terms of the returns, and it's not risky, right? So I think this is an important little bit to understand. So for a lot of people, and by the way, even if you look at like this year, this chart is a couple months old, but you can, if you look back like 12 months from starting in April, I haven't updated this in a couple of months, but it's really the same idea. You can see the returns are all over the place. You had up months and down months and everything in between. And this is a very ill fit for you to have some sort of a positive return, again, on a month-over-month or quarter-over-quarter basis. Does that make sense, folks? Give me a quick guess if this makes sense for you. If you like maybe that introduction on terms of the stock market, the overview, and if this kind of makes sense for you. We're going to go into the strategy right now, and it's going to make a lot of sense in terms of the strategy for you guys in just a second. Cool. All right. Now, what we do know is that a lot of people's P&L curve looks a little bit like this mountain range. And this mountain range is very jaggedy, right? You have a lot of people do this. They have a few trades. So maybe they make money for 3, 4, 5, 6, 7, 8 trades. And then they have 1 or 2 stinky losers that wipes everything out again. And then they have another few trades that make money, and then they give it all up again. And they continue doing that. And a lot of you are probably relating to this. I certainly am. I'm raising both hands. I've done that for way too long. And the problem with it is not only that you're not making money, but it's a psychological problem. And the psychological problem is that you're doing a lot of work for essentially nothing for trading sideways. And what happens then is you basically become more and more antsy, and you basically become a gambler. And that is ultimately the death knell for most traders and investors. So what we've found is that a lot of people need some sort of a base income, like some sort of a monthly or quarterly return, just to be able to stay in the game psychologically. And I want you to really think about that. How much more calmly would you trade? How much more willing would you be to stick to your rules and not worry about chasing every chart that goes up or down every 5 minutes if you knew that someone at the end of the month were to give you $3,000, $5,000, $10,000, whatever the number is, right? I really want you to honestly think about this. How much more calm would you be, and how much more rational and taking your time would you do at looking at your trades? And the answer is probably a lot. Right? So it doesn't matter whether you're working part-time, full-time, maybe you're retired or soon to be retired. the strategy is great because it doesn't require a lot of time and it's not hectic, but it really works on building you that monthly or quarterly positive return, kind of like a base income in your trading and investing activities. So we found is that for a lot of people, those stagnating or losing accounts ultimately turn you into a gambler. I've been there, I've done that before, and I'm sure, like I said before, a lot of people are probably experiencing that or have experienced that in the past. And that in turn leads to, loss of confidence, breaking rule, forcing trades, and then essentially you're just gambling, right? And that's just an absolute, the worst thing that can possibly happen, right? So what we're gonna do is we're gonna show you a strategy right now that, first of all, I promise you it's not difficult. What it is low stress, high probability, and most importantly, it's very repeatable. You might hear of a lot of different strategies out there, but a lot of them are not very repeatable, and that's a problem. Furthermore, it doesn't require a lot of time. About an hour per week or so is what I'm saying. Profitable trades, so out of 10 trades, you'll have roughly 8 out of 10 should be profitable, and the 1 or 2 losing trades that you'll have are not going to wipe out all those gains of the previous 8 trades. And that's very important, and a lot of little minor detail that a lot of people leave out when they talk about the strategies. Now, at the very core of the strategies is a little chart that I call steep to vertical. And if you guys look at the stock market right now, you'll find these kind of charts all over the place, right? And so you have a steep rally that goes vertical, and at some point, the stock simply can no longer sustain that vertical move, and it stops going higher for a period of time. Same thing on the downside. Here you can see Walmart. Steep move to the downside, followed by a vertical, or we call it a parabolic drop. At some point, the stock can simply no longer sustain down there, and it stops going lower for a period of time. So when these moves happen, the implied volatility increases or becomes elevated, and I'll talk about what that means here shortly. Investor fear or greed reaches extremes, and the reward to risk for what I'm going to call a counter trend trade right now become absolutely amazing. And we'll talk about this here, what that is in just a second. So I have one more question. Type in a yes if you have ever traded an option before, or no if you've never traded an option before. And by the way, it totally doesn't matter whether you have or not. I'm just kind of curious how many people here are familiar with options and how many people are not. It does not matter at all if you've traded options before or not. This is easy. You'll be able to do this with a little bit of training. Okay, some people yes, some people no. This is actually absolutely perfect. The reason I'm asking you this question is because of the following. I'm going to go through a couple of options selling statistics. These statistics are true, okay? But if this stuff is not done correct, it will not work for you, and it's actually very dangerous. Let me repeat that. The statistics I'm about to show you, they're technically true, and you'll hear a lot of people talk about this. But unless options selling, the way we do this, is done right, not only are these stats not true, but they're unbelievably dangerous. So what people will tell you is that the odds are strongly in favor of people who sell options. What does that mean? Well, what we know is that more than 75% of options that are held to expiration expire worthless. So assume that you buy a call or a put and you were to hold it through expiration. The odds are 75% that you are going to lose money, right? In other words, you have a 25% chance of making money. But if you flip this around and you become the seller of an option, you then should, by definition, have a 75% chance of making money. Now, again, it's true, but unless it's done right, it's absolutely dangerous to believe that statistic. The other thing people will tell you is that the longer you hold your short option, the better your odds of success. The thing is that options are a wasting asset, meaning they lose money over time. So the longer you hold them, the more you lose money. So if you own an option, by definition, it'll waste away, right? And what they'll tell you is that if you're a seller of options, you want that value to decrease, of course, and so they want you to play the theta game, the time decay game, which I'm here to tell you, I should say, is a very, very dangerous proposition. I would not do that, and they'll even tell you to do weekly options. In my opinion, very, very risky. So having said all that, here's what we're going to do together for the next 20 minutes or so. We are going to do 4 very simple steps together, and this is what they look like. You can write this down, take a picture of your phone, whatever you want to do. We're going to look for steep slopes that have gone vertical and give us signs of exhaustion. We're going to make sure that the implied volatility is elevated. We're going to make sure liquidity in the options is good. Very simple. You don't want to trade illiquid instruments. And fourth, very specifically, we're going to sell far out of the money call or put spreads with expiration of 2 or more months out in the future. Now, if you've ever done anything like this before, I can guarantee you with like 95% certainty or more that exactly what I'm about to show you, you've never done. We know that because we can see what people do and we can see what's being taught. So I would stay tuned and you'll see that this is a very, very different thing, but very simple thing that we do. And then what we're going to do, we're going to rinse and repeat this on a monthly basis to really create that monthly or quarterly cash flow machine with this strategy. So again, at the very core of this are these steep slopes that go vertical. And at some point, again, the stock becomes so overbought that it simply can't go higher for a period of time. Same thing here, you can see Netflix, steep slope, goes vertical, and at some point it's just so overbought, there's no more buyers left that it can't go higher anymore for a period of time. So when the slopes go vertical, whether that's to the upside or to the downside, they become capped, right? They will tend to stall in price. And that's really where the opportunity lies. And oftentimes you will get a sharp mean reversion move that follows very quickly, which gives us like the windfall profits. So let's have a look at some example trades. What we're going to do right now is we're going to spend a little bit of time going through some historical charts, historical examples. And then we're going to go into the live market. Stock market's open right now, so we're going to go into the live charts and show it to you. And I'm going to show you some stuff that's happening right now that you can that we can show you right now live as well. So again, first we're going to teach you the concept with some historical charts, and then we're going to go into the live market. So, and then what I'm going to basically ask you guys is essentially blindfold me, type in some tickers, and I'm going to prove to you that it works. So I'm first going to teach you how it works, and I'm going to prove to you that it actually works. I think that's always a nice twist. So this is a chart of Facebook, as you can see. And you can see at the time there, it had a very steady but steep incline within those two parallels. But you can see that every time, or a few times, it had these like sharp outbursts, these like vertical moves here, and here, and here. And while it's true that the stock after each of these outbursts mean reverted back into this steep channel, what's more important to understand is that after a while, the stock stopped going higher for a period of time, right? After the vertical move, it stopped going higher at some point for a period of time. It happened here, 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 and it also happened here. I happened to cut off a chart here at the time. All right. So what I'm going to do is I'm going to actually bring over the actual charting platform here so I can draw on this and show this to you guys as even better. Okay. So same chart that I showed you a second ago. It's just now we're on the actual charting platform so I can draw on this. So again, we're at one of those points in time where you can see the stock moved to the upper end of its channel. And what could you do, right? So within the steep move, it went vertical. Who can tell me what could you do when the stock moves to the upper end of that channel? I mean, if you own the stock, I suppose you could take some profits. That's always an okay thing to do. Maybe if you wanted to be more aggressive, you could probably buy a put. You could buy a put spread, right? But who can tell me if you short the stock here or if you buy a put, what must the stock do in order for you to make money? Who can tell me that? If you're here and you short the stock and you buy a put, what must the stock do in order for you to make money? It has to go lower. That's the answer. So if you short the stock here or you buy a put, unless the stock goes lower, you will not make money. In fact, you probably lose money. But what could the stock do at that point? Does it have to go lower? No, I mean, at any given point, it could go lower, sure, but it could go sideways and it probably could go higher. So the stock can do one of three things. But we just talked about this a second ago. If you short the stock or you buy a put and the stock must go lower, it must go in this specific direction for you to make money, you have, by definition, a 1/3 chance of making money, all else equal, correct? Because you make money only if it goes in this direction, but it could do two other things. Does that make sense so far? This is really, really important, folks. And I would urge you to pay attention right now. If you're clicking around on your phone or dabbling on a different screen, please pay attention. This is really, really important. So if you short the stock or you buy a put, you're going to make money in one direction, which is a 1/3 chance of making money, all else being equal. And that's a problem, right? So instead of making these directional bets where you have to be not only correct in terms of timing, but also in terms of directionality, you have to be dead on correct. We like to make a different bet. The only bet we made in this particular instance is that the stock over the next 1 to 2 weeks does not go here. So instead of shorting the stock or making some sort of an aggressive bet where the stock must go lower now in order for you to make money, the only thing we said is, you know what? I don't care if the stock goes lower, sideways, or even against us. I just don't think it's going to go after this vertical rally within the steep move. I don't think it's going to go up here over the course of the next 1 to 2 weeks, which means I make money whether the stock goes lower, sideways, or in this particular case, the stock could have even gone 8%. 8% against you, meaning you could have been butt naked wrong and you would have still made money. Okay? Now, we're going to go into the details here. So far, can you guys see how this might just give you a higher probability chance of turning a profit in any given trade, since you can make money in basically 3 directions? It's indisputable, but the details are important. So let's talk about this. So what we did in this particular instance is we did what's called a bear call spread. And we do something very specific with these trades. So even if you've done this before, like I said before, stay tuned. You've most likely never done what we're about to show you, which is why this works so well. So at the time when we put on this trade, it was February at the time. Again, this is a historical example. We're going to go into the live charts in just a few minutes. And the only thing we did is we sold a call at the $125 level, and we bought against that for protection another call $5 higher at the $130 strike. So the only bet we made is that it doesn't go 8% against us. In order to make this bet, we actually received $1, which in options terminology means we received $100 per options contract, or $1,000 with 10 options contracts deposited into our brokerage account. So we're not actually paying money against this trade, we are receiving money. So fast forward a few days, and in this case, the stock did go lower, and I'm going to show you guys examples in just a few minutes where the stock did not go in the desired direction, and we made just as much money. But in this case, the stock did go lower. The $1 spread was reduced to 24, meaning we got to pocket the difference, which is 76 cents, which translates into $76 of profit per options contract, or $760 of profits per 10 options contracts. But the crazy thing is, the stock didn't have to go lower. It could have gone sideways or even 8% against us, and we could have still made just as much money. Give me a quick yes if you like this so far. Again, there's the devil's in the details, because this is just a basic bear call spread. Let's talk about the details here in just a second. Great. All right. Now, here is what makes this so different and why this works so well. I've done this for giant portfolios. I continue to do it for giant portfolios, and it works for tiny portfolios. It's just a very, very different way of looking at things, and it really, really works. And here is why. So at the time we put this trade on, it was February. Can you guys see that we used April expiration options when we put this trade on? April. We didn't use February options. We didn't use March options. We used April options. Now let's talk about for a minute what would have happened if we would have used, at the point there in February, some very short-dated gambling weekly expiration or whatever short-dated options expiring in February, very short-dated. Let's assume the minute you put the trade on, the stock rallied 5% against you. Any idea what would happen to your trade? Basically, you get your face punched in is the answer. Even though you're not making a directional trade, because you're using short-dated options and giving yourself basically absolutely zero room for error, you take it right to the face. Basically, if you have a car with 4 wheels, most of us do, except for those little 3-cart things that I see like in Italy all the time, those little 3-wheel things. But most of us have 4 wheels in the car, so you basically just lost 3 wheels. That's the point. You have a 1-wheeler left and it just sucks, right? So it toast. But let's assume, as we did, instead of using these short-dated gambling options, you used options in February that expired in April. And let's assume the stock also immediately when you put the trade on rallied 5% against you. Who can tell me what happens to your trade? Any ideas? The answer is you lose 1 wheel. You lose a little bit of money. And that's the key. So with this strategy, we are able to control losing a little bit of money. Most option strategies, you do not have that luxury unless you have a very complex option strategy with like 5 or 6 legs and you don't want to do that. That's just too complicated. So this is the way that we are controlling having very small losses or manageable losses and having winners that are very consistent. Give me a quick guess if this makes sense so far, because we're about to go into the live market here in just a second. All right? This is really, really, really important to understand. Great. So here's another example. We're going to look at Tesla here for just to give you an example here. Tesla, at the time, that again, this is a historical example. You can see the stock had a sharp drop, and then it went vertical to the downside. And so what we did here, instead of buying the stock, we thought that would have been way too risky. We simply sold a put all the way down here at the 120 strike. We bought another put against it at the 110 strike, received $2,250 deposited into our broker account with 10 options contracts, or $225 deposit in a broker account with 1 options contract. By March 16th, in this case, the stock did rally to the upside. That spread was reduced to 43 cents. We managed to close it, and we got to keep $1.82, which translates into $182 of profits per options contract, or $1,820 per options contract with 10 options contracts. Now, what's important about this, folks, is that our average holding period is only about 2 weeks on average. So just because we use options expiring way out in the future, does not mean we hold these trades very long. Our average holding period is about 2 weeks, and that's really the complete opposite of what most people do. The fact that we use options expiring 45 to 75 days plus in the future, but we only hold the trade on average for 2 weeks, is literally the complete opposite of what most people do, which is exactly why this works so well. Let's look at another example. This one here is on the S&P 500, and this happened in March. I'm just giving you a recent example because I think a lot of people know the S&P 500, and a lot of people probably are familiar with what happened at the time. So this was on March 16th when the S&P had just dropped. Let's see, how much did it drop? It dropped 30%, I think 28% over the course of 3 weeks. And we just thought that the stock was, the ETF was oversold, but we didn't want to buy it. So the only bet that we made is that the ETF, the S&P, wasn't going to drop more than another 18% over the next 1 to 2 weeks. That's the only bet we made. The funny thing is that on March 16th and on March 24th, when we closed the trade for an 11.4% profit, the S&P was at the same level. So if you would have bought a call or bought the SPY, you would have either stopped yourself out or lost a lot of money. But we made 11.4%. So the only bet we made is that the S&P, after having dropped 28%, doesn't drop another 18% over the course of the next 1 to 2 weeks. Does this resonate with you guys? This is really, 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 really important. So I hope this is making sense. So one of the great things about this strategy is that you don't have to pick winners because it's got such a high probability of you making money. All you have to do is essentially just make sure you close the trades when they go against you. And because we lose little money when it goes against you, you'll actually be able to do that. I think this is one of the most important things. And really the point is to create that income base, create these credit spreads at the beginning of every month or quarter to really create that income base for you to make money. So before we go into the live market, I want to play a quick game called Follow the Indicator. Can you guys all see this little blue arrow or these 2 blue arrows? And also, can you see that to the right of these blue arrows, the stock stopped going higher? Yes, it went lower. It went a lot lower, but it stopped going higher. You guys see that? Same thing here on Alphabet. You can see to the right of these blue arrows, for the next 1 to 2 weeks, remember that's our time frame, the stock stopped going higher. You see that? How about here in this ETF to the right of the blue arrow? The stock stopped going higher, right? So I want to play a little game called Follow the Indicator. And if you guys would like to type in some ticker symbols into the chat box, let's do that for the next couple of minutes. So type in some ticker symbols, and we're going to go right now into the live market, and I will prove to you that this works. Does that sound fair enough? Cool. All right, and I know you guys are going to type in a ton of these of tickers, so I'm just going to have to pick the ones that are people kind of know. So one here is on FXI. This is actually an ETF, and you can. Let me get back to the slide deck here. I'm just going to do it like this. All right. Here, can you guys see this? You see when the arrow stopped printing on July 7th? What did the ETF do? It stopped going higher for the next 1 to 2 weeks. That's all we care about. So what do? We sell a call up here. We buy a protective call against it. We keep the trade on for 1 to 2 weeks. We generate the income, and we move on. In this case, this ETF actually ended up dropping 9%, which is the bonus. We don't need that to happen. All we're saying is that the ETF stops going higher for the next 1 to 2 weeks. Stops going materially higher. It can still go higher, just not above this level. So you'll make money whether the ETF goes lower, sideways, or higher. Does that make sense? And we're going to go, by the way, if anyone's a day trader, I can show you guys how this works intraday as well. WDAY. All right, WDAY, this is workday. Let's have a look at workday. You guys can see just a couple of days ago, this thing stopped printing an error. In fact, it was 2 days ago on September, I wish it was November, September 1st, it stopped printing an error. Since then, the stock is now lower by 8%. So what do you do on September 1st? You sell a call, you buy a protective call against it, generate the income, keep the trade on for 1 or 2 weeks, and move on, right? And yeah, of course, I mean, this will work on the bullish side as well, of course, absolutely. We can look at some bullish stuff as well if you guys would like to, for sure. But let's have a look at more. I want to make sure we actually take your things. Zoom, sure. Let's have a look at Zoom. Here's Zoom. Since we're using this software, might as well talk about its stock, right? Here is Zoom. Yesterday it had the arrow. Today no longer an arrow. So far the stock is already down 10%. So what do? You sell a call up here. You buy a protective call. Keep the trade on for 1 or 2 weeks. And you move on. And you can do the same thing if something's very oversold, right? So if you guys have a stock that is giving you a signal, like for example, Sienna today, just so you guys know, it's printing us an arrow. So I'm going to wait for this arrow to stop printing, and then I'll probably sell a put down here, buy a protective put, keep it on for 1 to 2 weeks, and move on, right? How about CRM? Sure, that's another one. This one also triggered the other day. CRM. Okay, it stopped printing an arrow a couple days ago. So what do? You sell a call up here, buy a protective call against, keep it on for 1 to 2 weeks, and take the profit. So far, the stock is down about 4.5% since those arrows printed. You guys like this? Etsy, sure. Actually, Etsy's interesting. This one was a trade that we actually gave our clients just in the early August, and you can see this is the actual trade. We're already closed out of it, of course, since. You can see it stopped printing arrows on August 6th. And what did we do? We sold a call, bought a call against it, kept it on for, I think, a week and a half. Since then, Etsy is now down 11 or 12%. Happy days. We actually just a few days ago, we gave people another trade in Target TGT. This was, I think, a week and a half ago, something like that. Anyway, it stopped printing the arrow on August 21st. What do? You sell a call, buy a protective call against it, and move on. The stock since then is now down 4%. You definitely want to take profits here. QQQ, same thing. We did that there as well. Is anyone want to do an intraday chart? I'm happy to show you intraday charts if you guys would like to. Like we could even look like right now, for example. Like let's look at the S&P 500, like the E-mini futures. You guys want to look at that? Like it actually works intraday. This is right now, right here, right now, live. Okay, look at this. It stopped printing an arrow at whatever that was, like 11:20 in the morning, Eastern time, and then it rallied 88 basis points. Right? I mean, you could make a lot of money. Like I wouldn't do credit spreads intraday, but the point is, you can use the indicator intraday if you want to, right? This is right now. I'm not making up. You would have had a beautiful move. Okay, Roku, sure. Roku, this is for AJ. You want to look at Roku? This here is yesterday in Roku. It picked the pre-market open, the high, then it picked the low of the day. You think you can make money with that, AJ? All right. How about, let's see, intraday. How about more? You guys want to look at more futures, so that's fine. RTY, sure. This is right here, right now, live, right now. Russell 2000 futures. It picked the low just before I came on here. Sorry, I'm gonna bring it up here. Would have been a nice trade, right? Do you guys like this? Yes. All right. So the thing is, folks, and we can go on and show you these charts all day long, but the point is, this thing really, really works. It's one of those things where the proof is in the pudding. The odds are so high that you make money with a strategy like this. What's important is you cut your winners, right? You lose because you cut your losers, and actually your winners as well. You don't want to keep them on too long. So as you've seen, this is a process that works. And so what I'd like to do, introduce you to the options income secrets, because that's really what you hear today. You hear it because you want regular income, and you want to know why and how regular traders like maybe myself that have done this on Wall Street and other places, how we're able to keep producing results month over month or quarter over quarter, again and again. And so what I'd like to do is I'd like to give you the full Monty, the everything. I want to give you the options income secrets package. What you're going to get is you're going to get the monthly options income strategy that I've shown you. That's going to help you produce regular income over and over again. I'm going to give you this low stress, high probability cash flow income strategy. The benefit, of course, is that it gives you steady and regular income into your account. Essentially means that now you don't have to second guess trades anymore, and knowing that every month or quarter you have this reliable strategy to really put the odds in your favor and dollars into your account. Now with this package, you're going to learn how use options the way the pros do. The benefit is that you start trading with confidence, you start trading with a process, and it gets a little bit easier every day until it essentially becomes second nature. And I'm going to give you my cheat sheet as well so you're not alone, because trading is all about having a process. And I really can't emphasize that enough. So when you follow a cheat sheet, it's there exactly for that. It's to follow a process. And I'm going to give you that edge in the market, which is the indicator and the scanner that I just showed you. You're going to get that as well. So this is not only about education, because I think having an edge in the market is important. And there's a reason why winning traders win like they do. And it's not only based on knowledge. So what I haven't shown you is how the scanner works. And I'll show you guys in a minute. You can install this in a bunch of different places, including on our own Market Rover platform. But it's super simple. So basically what you do is you just bring up the indicator. So like here, excuse me, you bring up, not the indicator, you bring up the scan. So let me bring down the chart. So like today, for example, right now you can see these are overbought stocks, right? So I just clicked on Cal. I don't even know what this is, CAL. And you can see the indicator right now. So we have to wait for it to stop printing an arrow, and then we could sell a bear call spread. Look at what happened last time it gave us an arrow down here when it was oversold in March. What do? Well, you sell a put, you buy a put, or you could even buy the stock technically, right? But really, we're all about its credit spreads. The stock ended up rallying 240%. Just FYI. You guys like this? Okay, so if you like this indicator as well, what you can do is you can actually install it on Thinkorswim, on TradeStation, NinjaTrader, TradingView.com, and it works on our own Market Rover Pro as well. So if you don't have any of these, you can use TradingView.com. That's essentially like a free, you could create a free account. It's a website. You go there, you install it there. Once you've got the scan from us, or the code from us, I should say, and you're off. So Thinkorswim, TradeStation, NinjaTrader, or TradingView.com, anyone can create a free account there and you can make it work there. What makes the Vertical X Pro indicator so great? It's that it gives you access to the highest probability credit spread income trading setups. And also, if you want to do directional trades, intraday, and any other way, it works for that as well. We actually have an algorithm that. So I'm going to give you a platform and a foundation that whether you're new to trading or whether you've been trading around for a while, you have the strategy and you have this tool that you can rely on month over month, quarter over quarter, just to create that regular income. And that's really what this is all about. So you're going to get everything you need to make this work. You're going to get a course, you're going to get the indicator and scanner, you're going to get a cheat sheet, and you're going to get monthly lifetime webinars where we give you a trade idea every month, and we teach you how to use it every single month. You can go to steadytradersecrets.com/secrets. I think it's actually the wrong link that I'm seeing in the chat box. It should be steadytradersecrets.com/secrets, I believe. You guys may want to check on that. Here's what some of the people are saying. Just people are really adapting this and making money with it. Who's this not for? I'm going to skip this because I want to quickly show you guys right away where we get to. But if you like this, if you can see that it works, and I hope you can see that it works because I hopefully just proved it to you by just taking your ticker symbols blindly. If you were to just get the course, that would be $199. If you wanted to get the monthly member session where we give you a trade every single month, sometimes 2 or 3 of them, but we do multiple sessions a month. We teach you how to use the indicator and scatter every single month for life. That's $497. The indicator itself is $2,000. We have an iron condor module we added that's essentially priceless. The total package value is $26.93. We're going to give it for the next 50 people, and it is really capped at 50. So after that, the price goes up again to $26.93. It's $297. It's a 90% off discount. Now, what I will tell you is that this is not a recurring fee. It's $297. You pay that one time in your life, one time, and it doesn't. You don't have to pay it ever again. It's one time. So what you do is you get this now. If you want the next 50 people, you can get it, and you will have access to the indicator, the scanner, the course, the cheat sheet, and of course to the monthly members webinars. Those are unbelievably important because we give you a trade every single time. It's $297. It's not a recurring fee. It's not a monthly fee. It's not a quarterly fee. It's not an annual fee. One time that you're a member for life. What I'll quickly say is that the next live scanning session is September 14th. These things always get recorded. It's at 10 a.m. Eastern, 7 a.m. Pacific. And you come in, we give you a trade, we show you exactly how this works. So I'll just tell you, for example, the trade we just gave people literally I think it was last Friday, if I'm not mistaken, is we gave people a trade to sell the QQQ bear call spread. In fact, I can even prove that to you because it's here. This is the actual, let me quickly find it here. And we're actually going to send this to you as well. Here, we actually type, this is the idea we give. It's already making money. It's probably already profitable enough for people to get out. Before then, we give people a trade in Etsy. I showed you that a minute ago as well. That's the bear call spread we give people in early August. And then we did one on Target. I just showed you that as well, right? You can see that, and that's already beautifully profitable as well. And that's it. So while it's not a specific trade alert service, what this is all about is teaching you how this works. You come back every single month for life, and we give you a trade idea with specific entry points, exit points, and we teach you how it works. So I'm about teaching you how to fish, because I don't think unless you teach it, you can really, unless you learn it, you can really make money. But we do also give you a trade. Every single month, we do 1 to sometimes 2 or 3 webinars. I think we've done like 20 webinars already for members this year alone, and we do that every year. I think last year we did, I don't know how many. So if you guys want to come back every single month, most members do because they want to get the trade. They want to learn more about how to use the indicator and specifically how to use the strategy. Give me a quick yes if you guys like this. Yes? No? Maybe? I'm going to start my video. That's how excited I am about this. Cool. All right. I know we have a few minutes left, but I wanted to maybe open it up if there's any more questions we can go through. If anyone wants to chime in. Yes, it's going to work intraday, Paul. It's just the point is it's meant to be used with the scanner, right? So intraday, the way we use it intraday is we have a bunch of charts open, like 6 or 7 charts, and then we focus on those. Like for example, I just showed you the E-mini a second ago, right? Let me quickly show you that again. Let me just go back to that. Or let's just look at, yeah, let's look at E-mini or RTY. We showed before as well, right? So this is right here live right now. This is an intraday chart. Now, again, we use it mostly for credit spreads. That's the point of it, but it does work intraday. I mean, if you would have done this trade this morning, you would have made a quick 1% in the Russell on a counter trend trade. So, I mean, it's right here, it's live. You can see it's ticking live. So, anyway. Well, once you join, again, Atul, we have a webinar every single month. That's where you come, you ask you questions. We have people that can help you install it as well. If you want to see what the members area looks like, this is what it looks like. You come in, you go to the members website, you click on Vertical X Pro. You know, anything you want to install it on, you can install it there. There's all the support you need, and we also have all the past recordings, or I think this year's recording of the webinars are all there. You can see all there, so you can watch those.
Hey, Serge, let me ask a quick question here. If you're relatively new to options, is this a service for you, or do you need to have more experience to take advantage of this?
I don't think you need to have a lot of experience in options. What I don't teach is what's a call and what's a put. Go to your broker for that. I mean, honestly, that's a simple thing, you know. But what I can tell you that this is not hard. Like, all you do is you place these orders with one click on your brokerage account, right?
Okay.
And we tell you, like, when we give you the trade ID every month, and when we teach it to you, we tell you exactly where to get in, where to get out, how to place the trade, what the stop loss is, the profit target, everything in great detail. And we do it every month, right? So really, like, if you guys want another source of income, and if it's worth it to you to actually study something for a bit, I mean, and we even give you like a silver platter with the trades every month and
Sure.
And the indicator. It's awesome.
Well, you know, it's interesting. I asked that question because, you know, we've read all the articles about how many people are interested in trading since they've been sequestered at home and they've been checking things out, and options are just exploding. So I think your point is, as long as you have a fundamental understanding of, like you said, what's a call, what's a put, this is a service that somebody should be able to adopt and use.
Absolutely, absolutely. And do you know how many new broker accounts were opened this year in the United States?
I have no idea.
75 million.
Oh, good Lord. Okay, enough said.
Yeah. So look, guys, this stuff really, really works. I stand behind it 100%. We do a webinar every month. I mean, it's ridiculous what we're giving you here, but you have to actually join the webinars. You know, you don't have to be there live every single month, but if you want the trade, you know, we'll send out the recording. What is important also is that you actually are willing to be actually interested in making money. That kind of helps. And really look at it like as another source of income. I think that's important. You know, it really is supposed to be another source of income. We look at their monthly or quarterly returns.
Sure. And really, as we're winding down here, one last question I'd like to ask you, and I'm posing this to all the speakers. As you sit there in your office and you're surrounded by your system and you're making decisions about how to trade the markets, when you think about what's going on today, the uncertainty around the world and the presidential elections coming up in the United States, is there anything that gives you pause or concern, or would have you change or modify the way you look at the market, Serge, given just how historic the situation is?
You know, as a money manager in our RIA, really what we're concerned about is with global macro, because I think what a lot of people don't understand when they start is that it's the dog that wags the tail and not the other way around. So, like, for example, today you can see tech stocks are selling off. Why are they selling off? Are they selling off because it's just they want to sell off? No, when there's a move happening in the dollar, there's a move happening in bonds that's actually triggering this, right? So I think it's really that top-down approach like that solidifies it. Now, you don't need to know that to make money with this. This is a great way to really have an indicator that works, whether it's intraday or through, you know, the credit spreads that we do.
Sure.
But I think ultimately that's an important thing to understand, is to understand how things correlate with one another, whether that's different asset classes or you know, the markets are global.
Right, exactly. So it sounds to me from this perspective, there's nothing particular that is giving you pause. In other words, you're not standing on the sidelines waiting for the election to occur. You're basically saying, look, I've got systems in place. I've got knowledge of the industry. I expect volatility, but I have a way to handle that. And you look forward to it under the right circumstances.
Yeah, I think there's always a de-risking and a going back into risk at periods of time. So we certainly would want to de-risk and prepare for higher volatility here for the next couple of months. Historically, a couple of charts that showed at the beginning, you know, are historically relevant. But yeah, I mean, at the end of the day, this should be a game plan, and this, I think it's a great indicator to help people kind of, you know, have a more steadier stream of returns.
Absolutely. Well, Serge, thank you so much for your time today, for preparing this presentation, for delivering it. It was a very, very fast hour, and it was delightful seeing you again. And once again, say hi to Stephanie for me.
You say hi to Stephanie.
I'm going to grab the screen here for a second and just want to remind you once again that he's got a terrific offer here for the Options Income Secrets Package, which is a low stress, high profile cash flow strategy. It includes the vertical X Pro indicator and scanner, which he demonstrated. And this works on Thinkorswim, TradeStation, TradingView, and Market Rover. And all you have to do is go to studytradersecrets.com/secrets. Once again, great presentation. Some things I noted during his presentation that I really liked. Once again, there's a lot of simplicity in the way he treats the market. And if you remember that slide, the 4 key steps: look for steep slopes, look for implied volatility, make sure liquidity is good, and then look for far out of the money call or put spreads. I mean, you could really put that on an index card and have that in front of you. And that's the key to how he approaches the market as a steady trader. So once again, Serge, thank you so much for being with us. Really appreciated that. And you know, it's the top of the